Hello and welcome to CMC Markets Trading Outlook for the week of October the 13th, 2014. My name is Colin Szynski, Chief Market Strategist. Our topic this week is going to be, will earnings season save stocks or sink them? We had a big correction in stock markets and a lot of volatility in the week that's just ended, and now we're moving into the heart of earnings season, and the question facing traders is this big stock market advance done, and what is going to happen with earnings? Have stock markets already fully priced in the earnings? Are traders looking for more? Are they looking for an excuse to get out? What's really happening as we move into earnings season? Because we've had the first few reports last week, but this week we really start to move into the heart of earnings season. We get a lot of big announcements from U.S. banks as well as U.S. technology companies that could really move the markets. So I'm going to start by looking at some action in a few of the U.S. indices, and then I'm going to show a couple of specific companies and what we may see happen over the course of this week with earnings reports. Looking first at client sentiment on the Nasdaq, we see here that the traders are actually extremely split at the moment. We have in terms of the number of clients, we're 52% bearish, and on the in terms of position value, we're 48% bullish. So we're pretty much running 50-50. Traders are really indecisive as to what to do heading into the current earnings season. In the last week, we've seen a correction start to unfold in the stock market. I'm going to start with the US 30, which as we can see has been had peaked here in early September, and it's been starting to retreat over the last few weeks. Now there's two things really that are driving this. The main one is that we're starting to see we're approaching the end of the liquidity cycle that has fueled the rally of the last 2 years of stock market rallies. The QE program that the US has been tapering over the last year comes to a hard close at the end of October. The last two times QE programs ended in the United States, the stock market went down 10% within 3 months. This time around, we've already seen the big correction happen in currency markets. We had a massive rally in the US dollar through August and September and into October, but stock markets really have not fallen off to the extent that they have in previous corrections. They still remain vulnerable. With that happening, the other thing to note is that we often do have a seasonal soft patch in stock markets that runs between about mid-August and mid-October, and that's often the worst time of the year for stock markets. This year, as we can see, the Dow peaked in the middle of September, so this correction started about a month late. It is possible, based on that we could see the normal seasonal correction in stock markets end a month late. This could carry through into the middle of November. Two things right at the end of October that could keep markets choppy. One is the Fed meeting with October 31st, the date when they are expected to bring QE3 to its final end. The second thing is early November, we have U.S. midterm elections, could also keep some choppiness in the stock market through this period, and also earnings season, which runs from mid-October through to mid-November, also could see a lot of action in stock markets off of that. What are we seeing in the Dow? It's been steadily retreating. In the last week, the volatility has really picked up. We had a big down day on Tuesday, a big up day on Wednesday, an even bigger down day on Thursday with this bearish engulfing candle, and then a little bit of consolidation on Friday as traders decided to take stock heading into the weekend. What's also quite intriguing about this now is if we move to the Nasdaq, we'll see that the concentration in stocks is changing, and in particular sentiment towards things. The US 30, of course, is a small number of large cap stocks, and if enough bullish money can concentrate in a few stocks, they can keep the market up. However, when we look at broader indices, show that the breadth has been terrible for quite some time. We look at the Nasdaq because in particular it contains a lot of high value, high growth, high momentum plays that at the margins tend to rally more than the market, and then tend to come off more than the market. And what is the Nasdaq telling us? It had been trying to hold up above 4,000 here and through September, and then above 3950 through October, and now it's starting to break down in a pretty significant way. It's taken out 3945, which was a big support level, which was also a 23% Fibonacci retracement, and it is now starting to work its way significantly lower from here. Next Fibonacci support is around 3845, the 200-day moving average. average is down around 37.65. Here, if we look at the momentum, we have a number of signals flashing for the Nasdaq 100. First, we had a head and shoulders top in the RSI in the early summer. That one failed, but then we had at the September peak we had a negative divergence, a higher high in the index, a lower high in the RSI, indicated upward momentum slowing. Since then, we've had the momentum tracking down, and both of them have been reinforcing each other, both the index and the RSI. What's significant here, once it went under 50 into correction territory, it's been unable to get back above it. Momentum continues to point lower for the Nasdaq in the near term. And one of the things we're seeing as we started to move into earnings season is that even though we had positive reports, in particular from Alcoa and from Pepsi, we're seeing the markets continue to go down. What's that telling us? It's telling us that even if when news was good, that traders were looking for a reason to get out, to take profits against the news. And what are we actually seeing when there was a disappointment? Well, on Thursday night, we had two profit warnings from the technology sector, and that's one of the things that's been driving the Nasdaq lower on Friday. But in particular, a company called Microchip came out with a big profit warning. It's driven down the semiconductor sector pretty much across the board. Why is this significant? I'll show the chart for Intel. Intel is the first of three big earnings reports in the technology sector this week. So we'll start with them. And what's particularly significant about Intel is this. The stock had a fantastic run through much of the summer. It's leveled off through August and September. Upward momentum was slowing. We see it here in the declining RSI, and RSI dropping under 50. And then on Friday, kaboom. Breakaway downward gap below 33. This wasn't on an Intel profit warning. This was on somebody else's profit warning, and the stock still got crushed. So what does this mean heading into earnings? All of a sudden, people are a lot more cautious about earnings. People are worried that traders may decide to take profits against the news rather than get excited about the news. And the third thing we have to watch for this time is that the risk of shortfalls either in the earnings or guidance is growing for two reasons. First of all, we're seeing a significant weakness in offshore companies in Europe and particularly in Asia, with China slow and with the amount of negative economic reports coming out of Germany over the last week suggesting that the European economy looks like it's in a lot of trouble too. As those economies slow can impact U.S. corporate earnings, could lead to disappointments in earnings and or guidance. The other part we've got to watch for as we move into earnings season is what happens with the U.S. dollar effect. Currencies don't move that much in a short amount of time. A 1% move for a currency is pretty big. The 8% move that the US dollar had over a period of about 6 weeks is absolutely huge. So what is this going to do to earnings? Because it can impact US companies in a number of ways. For US exporters, it makes their goods more expensive abroad. That could cut into their sales. For US multinationals that do a lot of sales abroad and have major international and overseas operations, when those profits are brought back into US dollar terms, they come back smaller because the US dollar has gone up. That can impact earnings. The final thing, though, is that if you're a U.S. company that imports a lot, life is really good because your costs have just gone down dramatically. So we'll watch out for that, and how does that play out over the course of this earnings season. So Intel has taken a pretty good solid hit here going into its earnings report. It suggests that the enthusiasm that we had is really starting to wane, and people are worried that we may see more disappointments in the chip sector. The second company that I wanted to highlight in terms of U.S. momentum plays and technology is Netflix. Intel reports on Tuesday. Netflix reports on Wednesday. Netflix has been a huge momentum stock in the U.S., and we're starting to see that at the margins, these are starting to contract. We've had a pretty good advance here over the last couple of years. There was a correction in the spring, made it all back in the early by summertime. But what have we seen over the last 3 months? Head and shoulders top forming. We had a left shoulder at the end of June. A head form here over the late August, early September. A right shoulder form here about in early October. We have a rising neckline. At the same time, we've had this higher high at the head. We had a lower high on the RSI, so we had a negative divergence. Momentum is starting to break down, and we're coming back at this neckline here. The support level we'd be looking for around 445, 435 as a zone. If that gets taken out, this could have a fairly significant retrenchment. So keep an eye and Netflix. It's one of the poster children of the big tech rally, the big liquidity-driven rally we've had of the last couple of years. If we start to see this break down, then it would be a sign that we're getting a real retrenchment going on. The third name, that company that I wanted to highlight in terms of earnings reports this week, is Google, who reports on Thursday night. And they also have had a pretty substantial move over the last year or so. I'll just bring the chart up here. We had its gains were mostly in late 2013 into the early part of 2014. We had a spring correction is coming up, but basically since the middle of June, the trend has been pretty much sideways for Google. It's been trading in a channel between about 570 and about 610. And but what have we seen recently? We saw the momentum starting to break down here. We've had a fairly consistent slide in the shares for the last month. On Friday, we're starting to break down below the bottom of this channel below 570. It's also not only a channel low, it's also a Fibonacci level, a 23% retracement of this big move back here. And so what are we seeing? Next potential support, there's a couple of previous lows in and around 550, another Fibonacci level in and around 540. So earnings season looks like it has the potential to have a really big impact on stocks and on indices. This time around, we're seeing that whereas previous in some quarters, most names only really impact themselves, we're starting to see companies' results impact the results of other companies. We saw that on Friday in this big chip sector sell-off off of one company's earnings shortfall. In addition to the U.S., where the focus is really in on earnings this week, we could see some action in other parts of the world. Overall, there's not a lot of big economic data coming out. The numbers that are coming out are primarily on the inflation side. We have China inflation coming out on Monday, Germany inflation midweek, and Canadian inflation on Friday. So there's where we're seeing, and also during the week we have the UK employment report. Those are kind of the major economic announcements in other parts of the world. In the United States, the results are primarily regional results. The Beige Book comes out, the Empire Manufacturing, the Philly Fed, things like that. So definitely kind of middle tier regional type of reports for many countries. We do see, however, that in the last week we've had European markets have been crushed really hard, and because of that, it is possible that we could see a bit of a pause or a rebound. I'll start with the DAX. The DAX has been really dragging on markets over the last week. Germany has been the bandwagon driving the European economy, particularly in the last several years. It looks as though the Eurozone's problems may be finally catching up to it and the wheels falling off the bandwagon. We've had a number of negative economic reports out of Germany in the last week that has really hit hard on the DAX, and we've seen it fall over the course of about 3 weeks from up around 9,900 down to around 8,830. We've seen a number of Fibonacci levels just get taken out one after another after another. Currently, it's testing a 61% retracement level down around 8830. If that holds, we do have the potential for a bit of a rebound here, perhaps initially towards 9,000, around number 9065, a Fibonacci level. If this gets taken out, next previous support resistance level is in and around 8225. To note here, though, on the RSI, we are getting a bit of a higher low, a possible positive divergence, and RSI is getting oversold, so we could see some sort of a washout in the DAX and perhaps a little bit of stability as markets start to price in the risk of a weaker German economy. The other one I wanted to look at briefly here was the UK 100, which also has been under a lot of pressure lately. We'll see that for most of this year it's been kind of holding up in a channel pretty well, but after its another failed attempt to break through the 6,900 level, it's really fallen out of bed in the last few weeks. It's been and most of this started with the uncertainty around the Scottish referendum, but the reality is it's kept right on going. Mostly that suggests it's also responding to the weakness in the Eurozone, with the UK economy still sensitive to problems on the continent as well. So recently we had a big bearish engulfing candle here, showed a dramatic upsurge in selling pressure. On Friday we're having a doji. Things are coming back into a little more balance. RSI is close to oversold. Perhaps we do see it start to consolidate. Initial resistance around 6,400, then up around 6,560. These highs in here, with downside support around this low around 6,300, and then around 6,255, which is the next Fibonacci level down. We also could see quite a bit of activity this week, again in Asia Pacific markets as well. Although there's less in terms of data, the big one being the Chinese inflation number, we could still see some activity, particularly around commodity prices. And actually, before I shift to talking about that, I do want to make a quick mention of what's been going on in commodity markets. With the rally in the U.S. dollar, we have seen the commodity markets under a lot of pressure. However, we have seen some rebounds more recently. We'll start with gold, which, when the U.S. has been trading opposite to the U.S. dollar for the last little while, it had gotten extremely oversold. It traded down to about 1180 and tested a key support level. It's bounced off of that, well up above 1200, running into resistance around 1230, with some support in the 1215, 1220 area. So if the U.S. dollar continues to have a correction, we could still see a bit of movement in gold, although I suspect for the current week, it'll probably digest the gains of last week and consolidate me probably in this 1210 to 1230 kind of area. But the one that's looking pretty intriguing as we head into the new week is energy prices. So I'd like to look at the crude oil Texas price in particular here, which has had a huge sell-off over the last few months. It's become extremely oversold, and but we are seeing RSI getting oversold once again more recently. So what are we seeing here? We've had a huge dropout. We saw the U.S. crude get pounded down below $85 and then roar right back. So this has the potential to be a bear trap washout here. We saw a technical level get taken out, a lot of support stop losses get taken out, and now the bulls have come roaring right back in. So we're so far, so good. It would help if it got back up above $88 to really signal that there's an upswing underway. But in the short term, it looks like it's trying to stabilize in this 84 to 88 kind of range. Similarly, if we take a look at Brent crude, which has been hit particularly hard lately as well, we'll see that it has been falling. It broke 90. Now, what's particularly significant about Brent, it hasn't gotten back above it. So it's taken out this big round number, psychological barrier, but so far it's stuck below it. As long as it remains below 90, that confirms that a new down leg is underway, and it does remain vulnerable. This is about $88, and the next round number is in and around $85. But we are seeing an oversold RSI on Brent crude, so it is possible this could hold and it could rebound. But we really need to see it get back above 90 for any kind of a confirmation of renewed interest at this point. We'll see what happens as it plays out over the week. If it does get through, next resistance is here up around 91.50. So now that we've seen the commodities sector, we've seen that a lot of the commodity-related markets have been getting hit pretty hard. Particularly, we'll take a look at Australia here, which had been selling off quite dramatically of late. The RSI, though, has started to show signs of bottoming out, so that may be, even though the index, so the momentum is bottoming out, but the index has remained under pressure, selling down again. It's hitting support here around this 5140 level, which is a 51% retracement of a previous advance. If it fails here, then we could see 5100, maybe even 5000 at some point, but it looks as though at this point it might be more getting due for a bounce. And if we see commodities in general start to have any kind of a rebound, any kind of a relenting of pressure against them, then we could see the index bounce back a bit. First resistance here around 52.20, then this Fibonacci level in and around 52.70. The other markets to keep an eye on this week is the Hang Seng, which may remain quite active. Not only is it sensitive to what's been going on in terms of the Chinese economy, but also what's been going on with the protests on the streets of Hong Kong itself. As the protests have grown, the index has gone down on risks, on the concerns that there could be some kind of economic or other disruptions. When the protests have eased, the stock market has bounced back. So what we've seen over the last few weeks is a channel emerging between about 22,500 and about 23,500 to 600 on the upside. We may see the Hang Seng continue to trade back and forth in this range depending on developments, but day to day it still has the potential to be fairly active. So that concludes my remarks for this week. It's been we're coming out of a very active week for world markets, and it looks as though we are headed for another one. Although this time around we may see the focus more on stocks rather than on economic data. Happy trading, everyone, and hope you have a great weekend.